Welcome to the Treasury Update Podcast, Coffee Break Sessions, presented by Strategic Treasurer, the show where we cover foundational topics and core Treasury issues in about the same amount of time it takes you to drink your cup of coffee. I'll be your host, Jonathan, Media Production Specialist here at Strategic Treasurer, so sit back, relax, and enjoy the show. We are back with another Coffee Break session. Today I have with me Paul Galloway. Welcome back to the show.
Thanks for having me back, John. Always a pleasure.
Yeah, it's good to have you. So today we are discussing two different topics, and we're including them in one coffee break session. Today we're going to talk about what are derivative contracts and swap agreements. So Paul, could you start off by explaining what is a derivative contract and how is it used in financial markets?
A derivative contract is an agreement between two parties where the value is based either on an asset such as like stock as an example, or a commodity or currency that has value tied to market indicators such as like interest rates are a good example. Why is it important in terms of the financial markets? The way these kinds of contracts work is that you have two sides, right? Two counterparties, and they're actually taking different positions on either stock market or, let's say, interest rates in the examples I've given before. And so one person might be a hedger, the other might be a speculator. So you have hedgers, you have speculators. They're taking two opposite sides of a particular item, an asset, or a commodity or currency or some type of market indicator. And at the end of the day, it's a zero-sum game. Somebody wins, somebody loses. Let's say one party wins $5, the other party loses $5. And so when it comes to financial markets, it's a way to pair these two parties up together that have different views on what's going on out there. It's typically there's dynamic shifts for speculators. For hedgers, it's making sure that they're not losing something greater than what they're willing to take in terms of risk.
And can you explain the concept of swap agreements?
Swap agreements are kind of like derivative agreements in the sense that with swap agreements, you have two counterparties. Typically, these counterparties may have a different view of a particular item. And so they come together, they agree to exchange cash flows. And so examples could be foreign currency, or it could be like interest payments. So foreign currency that's paid on liabilities. I'm a company that's got to pay foreign currency. You may not want to pay the FX, or you want to lock in what that FX rate's going to be because you have a certain view of what's going to happen in the markets versus just accepting what the market is going to do over a period of time. Or you have interest payments. Let's say you're paying floating rates and you think rates are going to move a different way than if you were to lock in the fixed rate today. So you can lock in a fixed rate by exchanging floating for fixed. Or in the case of currency, maybe it's swapping US dollars and Great British pounds. And so you're just swapping the cash flows of those two particular items. That's the difference between a derivatives contract, which is hedgers, speculators on an asset or market indicator, versus swap contracts where you're exchanging cash flows.
Okay, that makes sense. And now when we were planning out our couple of coffee breaks, you wanted to pair these together. Why are we pairing these two together?
I think the reason that I wanted to bring them together is because there's some similarities and some differences in a lot of organizations when it comes to, managing these types of risks. Treasurers have a hand or touch these particular items on a regular basis. So it may be in the sense that there's a debt issuance that's done by the company, and you want to manage the interest rate risk. So you may engage in swapping interest rates, maybe floating to fixed or fixed to floating. Or it may be that you have payments that go out internationally or globally, and you want to try and manage the FX risk. So that's why swaps will come into into play. In the instance that you have derivatives contracts, this is also a play where you're trying to manage from a treasury perspective. You're not going to find that your treasurers are speculators. You're going to find that your treasurers are hedgers. This is typically the way it would work from a treasurer standpoint. And so you're trying to manage risk, and derivatives contracts allow you to do that. In either case, these are both complex in nature. There are risks associated with each of them. There's similarities, but there's also some differences. And these are tools that treasurers have available to them to utilize. So I think it was kind of important to bring out the two and just talk about those differences during this coffee break session.
To do a hedge, is a derivative contract necessary, or is there other ways to hedge?
There could be. You could synthetically create a hedge by engaging in investment activity that puts on a similarity to what a hedge might be. So you could either go long or buy, or you could short a particular investment or a position to create cash flows that would be similar or that would offset any potential loss that you might have from a derivatives contract standpoint. That's not typically what people do, but you could do that. And hedge funds are kind of a great example of organizations that are out there making investments that act as hedges to particular thought processes or theses of either market indicators or particular industries or regions. Hedge funds are created to try to exploit the dynamics. And so you could see that from an investment standpoint that would be different from entering into a derivatives contract. From a treasurer standpoint, you're not going to see a treasurer doing that. Treasurers are typically going to look to have, when they're trying to mitigate risk or perceived risk that they have tied to a business line, they're going to engage in derivatives contracts. They're not going to do it like a hedge fund would, or synthetically. They're not going to do it that way.
Okay, and back over to swap agreements. You mentioned some examples, but what are some of the most common types of swaps?
Most common types of swaps when you think of treasury are foreign currency, FX, and interest rate. Those two are pretty common when it comes to engaging in swaps. You'll see that quite a bit out there. The reason that is that treasury is tied to those cash flows in particular. So if there is foreign currency that has to be paid or received, it could be either way, paid or received, and they want to lock in those cash flows, they would enter into a currency swap. So they're trying to mitigate some perceived risk in the movement of exchange rates. Likewise with interest rates, if a debt issuance is made and they're trying to mitigate risk of movement in interest rates, and this may be either paying fixed, receiving floating, or vice versa, receiving fixed and paying floating. So it could go either way. It's just a matter of managing the cash flows, and that's why those swaps come into play when you're a treasurer.
I recently was talking to someone who has a lot of cost in a couple natural materials, and they said something with the new election that steel prices are probably going to go up, so they were putting in a hedge in place for steel cost. I'm sure that they were using derivative contracts for that.
Yeah, you could absolutely use contracts, swaps, derivatives. You could use those to exchange cash flows. You would typically see commodities show up in your derivatives contracts. So it could be anything that's an input into manufacturing. So steel being a good example of that. There's certainly a lot of other commodities that are tied to manufacturing where they might want to hedge themselves. And so derivatives contracts help mitigate the risk that, in this case, your example of steel prices increasing. When organizations are concerned about that, these types of contracts can really be beneficial to them. Now, the question is will that happen or not? You really don't know. There is some level of speculation out there, and there could be some people out there going, well, yeah, company, yeah, you think steel prices are going to go up, but I actually think they're going to stay the same or perhaps fall. A speculator comes into play, so you have somebody that takes the opposite side of that contract.
So I always like to talk about the risks of each item when we talk on the coffee break session. So what are the potential risks or downsides of derivatives and swaps?
What I wanted to do is, provide kind of an example and then lead into what some of these risks are. I worked for an insurance company that sold primarily fixed indexed annuities. And so what that is, people that are doing retirement planning, they may have a bucket of money that they want to lock in a particular cash flows. Annuities are a good way to do that. They exchange cash either in lump sum or payments over a period of time in an agreement to receive a certain cash flow in the future. These fixed indexed annuities that were sold at this insurance company were tied to the S&P 500. So as the S&P 500 moves, that means that the value of those cash flows also move. And to hedge those movements, we entered into derivatives contracts with a variety of banks. And when it comes to these types of contracts, as you can imagine, the underlying asset, in this case, the S&P 500, it moves daily. So the value of it is constantly changing. To hedge yourself, you have to post collateral to a margin account. You're posting something there in case there's a catastrophic loss or particular a default of some nature where you couldn't make the payment. The counterparty would take over the posted collateral. And so you would move collateral back and forth daily. So it's called mark to market. You mark the value in the morning. You exchange collateral in the morning. It could be cash, it could be securities, but these derivatives contracts were really put in place to hedge that risk that the underlying index moved the wrong way. And that way you could protect yourself on the downside. And so a lot of times organizations use these contracts, and there are risks that are associated with them. From a derivatives contract standpoint, the first piece is the counterparty. You want to make sure that you have a counterparty that's not going to fail. And so when you enter into derivatives agreements, as an organization or a company, they put an ISDA contract in place that it's part of that going through that process. There's a vetting to ensure that the counterparties have good credit. So credit's another aspect to think about in terms of risk. You need to understand the financial strength of the counterparty. Are they going to be able to do what they say they're able to do? Because you're exchanging value every day. It's going back and forth. They have to keep up their end of the bargain just like you do. The other piece is liquidity. Liquidity meaning the ability to meet the margin calls. You have to have cash available or securities available to meet those calls either way. Again, it's moving back and forth, cash and securities every day. The other piece is legal. I talked about, setting up the ISDA and getting a contract in place. Sometimes there's challenges from a legal perspective to getting these contracts in place because they are complex. And your legal folks, can take a little bit of time to go through these agreements. So they don't always happen quickly. So it may not happen as quick as what you want. And so there is some legal risk due to the complexity of these agreements. The other piece is operational. You have to monitor derivatives positions daily. And so if you're not doing that, there are financial costs associated with that. You have to do this every day. When it comes to swap contracts, some of the typical Risks include counterparty, just like I talked about with derivatives. Got to make sure the counterparty is going to be able to uphold their end of the agreement, the deal. They got to be able to be there. The other piece is, in the case of a treasurer, I gave examples of interest rates and exchange rates. Both of those fluctuate daily. These are things that are risks to an organization. You're taking a position on where rates are going to move over a period of time. Swap agreements are over a period of time, where derivatives contract can be more open-ended. Swap contracts are typically over a finite period. So you're taking a view on, in the case of the examples I gave, interest rates and exchange rates, that you know where the market's going to go. The other piece with swap contracts is basis. And when I talk about basis, this has to do with the interest rates. I'm talking about bonds here, doing swaps with interest rates. Interest rates paid by an issuer of a bond differ from what's in the contract. And so that's the basis risk.
There's a lot to consider on both sides there. Paul, thanks so much for sharing your thoughts today. And to our listeners, remember to tune back every first and third Thursday of the month for another episode of the Coffee Break Sessions.
This podcast is provided for informational purposes only, and statements made by Strategic Treasurer LLC on this podcast are not intended as legal, business, consulting, or tax advice. For more information, visit and bookmark strategictreasurer.com.